Hey guys, welcome back to Capital Mindset. We're with our hosts, Austin and Fabio, and today we're going to be talking about people's favorite stock for entertainment, movies, parks, and that's Disney. So if you go on YouTube right now, you probably have seen a lot of creators say that, Disney is the forever stock, the one that can never fail with all of this tremendous IP. However, our host here, Austin, he's found quite a bit of risk involved in ownership in Disney. Stuff that no one's really talking about. And he's going to kind of guide us through what that is and what are the implications. So Austin, first I want to ask you, what are your initial opinions about Disney? Do they differ from the common YouTube audience?
So honestly, before I kind of started doing my initial rounds of my preliminary analysis, Fabio, I was kind of looking at Disney more so from that perspective of that forever stock. So I was approaching this stock like, oh, I'm expecting to see record cash flows, good assets on the sheet, great earnings, et cetera, et cetera, et cetera. Like things that I would like to see in a blue chip company in and of itself. Yeah. But what I noticed, and actually, you actually talk extensively about what's known as a variable interest entity, and China operates. Yes, actually. I actually did. And this is where the story gets very interesting, Fabio. All right. So the Disney revenue stream is pretty much broken down into like 4 distinct business segments that they post on their financial statements themselves. So the first one is their media segment, which includes like NBC, ABC,
ABC. Okay.
Yeah. ESPN, like a couple other ones. And then they also have the parks and experiences, which is like, the Disney parks. Me and Fabio, we live close to Orlando. So Disney's it's a big thing down here. And we,
yep, it is.
They also have the Disney cruise lines and et cetera. And then you've also got the studios, which is like their third one, which is
Marvel,
Pixar movies, Marvel. Yeah. Marvel. All those great IPs, Star Wars, you're a big Star Wars fan, Fabio, aren't you?
Yeah.
Yeah. I mean, that's pretty much how every Star Wars fan feels nowadays.
Yeah.
It's like, yeah. And then the fourth one is actually consumer products and more of like an interactive thing, which is more the consumer products are exactly what it sounds like. It's toys and et cetera that like Disney puts out. And so what I found interesting when I was doing my breakdown of the preliminary analysis of Disney, Fabio, in the parks and resorts, Orlando, California, and the Paris Disney parks are owned by Disney outright. Mm-hmm. There's no obviously there would be a risk there in the operations, but in terms of a VIE, there's no risk there. Now, Hong Kong and Shanghai are both operated as VIEs, and they're consolidated on Disney's financial reports, their quarterly and annual financial reports. And they're also known as the Asia markets. So here, let me share my screen with you now, Fabio, to kind of prove to you what I'm saying here. So yeah, this here basically, they disclose right here in the notes to their consolidated financial statements that they are investing into VIEs, Fabio. Now, the exact percentages, I can't entirely remember if it's Hong Kong or Shanghai. One of them is 43% owned. The other's 48% owned. So, Fabio, right off the bat, I know that the VIEs, that entire word itself triggers you. What do you think about this?
I personally, until when we were discussing about these structures owned by Disney, and when you discover this, I'm just so shocked, okay, that this is happening under Disney. I mean, for example, I, like others, knew that when you do business in China, oftentimes you enter into what's known as a joint partnership. But I believed until now that Disney, when they engage in that joint partnership, they have the rights and they actually own the other half of that joint partnership. Now that I can see, as they actually publicly disclose here, that they actually don't, they own it through a variable interest entity,
which we have multiple other videos going over variable interest entities and why we specifically here at Capital Mindset honestly hate them.
Yeah, so
for lack of a better term.
A bit of context to the audience in case they might not know, a variable interest entity is an ownership structure that was designed so that the ownership of the owner of the VIE has very limited recourse, legally speaking, against the actual company that the VIE represents. So it's a way of not, if it's a way of owning shares that are not actually attached to the ownership of the end business. So it's a contract to a contract to a contract with a series of entities that owe each other, and you're not protected under property rights, you're protected under contractual rights and under many different jurisdictions. So the probability that you ever get proper legal representation and your rights fulfilled is actually quite low. And the fact that Disney is engaged in this in the Asia markets is such a red flag to me right off the bat. And I'm not sure from just this that I'm even comfortable with assigning a risk to this. I have no idea what this means.
Well, I mean, like that's kind of something that I want to explore after what I show you next, Fabio. If you thought the VIE structure itself was bad,
There can't be more.
just for some,
There can't
just
be
for some
more.
context, in accounting, whenever you come up with a fair value valuation of something, it's broken down into 3 levels. Level 1, for example, is like the most observable thing. So that would be something like a stock price, like this, the price Disney's trading at today when this video is live is a level 1 fair value input. A level 2 fair value input would be like the value of a building or something. And then level 3, Fabio, level 3 fair value inputs are unobservable inputs. Unobservable, and they rely off of like valuation models and other things. So now let me actually show you something here that I find even more interesting. Look at this. Level 3 borrowings include the Asia theme park borrowings, which are valued based on the current borrowing costs and credit risk of the Asia theme parks, as well as prevailing market interest rates. That all sounds good. But Fabio, this is a level 3 fair value input here. Level 3, Fabio. What do you make of that? Because to me, this signifies an unobservable input.
It's exactly what you're saying. There's no way for me trying to come up with a valuation model to really derive an appropriate value to let's say, what is that, debt? They're signing that fair value input level 3 on debt. Well, I don't know what that debt is worth. What are the implications of it? I have no idea. So that makes things more difficult for me. And when things get difficult for me as an investor, I simply just say, okay, well, I'll move on to the next thing that's not as difficult, right? Because those are uncertainties. And for me, that's how I define risk. Risk is just uncertainty. And okay, fair enough. You might say, oh, he's not smart enough to understand Disney. Yeah, sure. I'm not smart enough to understand.
I mean, honestly, though, like Fabio, like that's a very valid concern, especially with a level 3 fair value input there. Like that could potentially have ramifications to where like the numbers that they're posting might not, we're not making any statements of fact. This is just our opinions looking at a level 3 unobservable fair value input. They might not exactly be the actual value itself. So that there is already a risk right on their sheet alone in regards to their Asia market. So now something else that I kind of want to show you, because we were talking earlier, Fabio, about like how you wouldn't be able to assign sort of a discount rate. And I kind of want to walk the audience through now before we finish up this video and then plug Disney into our model. I kind of want to walk our audience now through what some of the implications might be if the VIE structure like just dissipates. You know, if like China comes in, seizes it, and it's just gone. And so to do that, we're going to use trusty paint. So right here. Okay. So we know that Disney, their business segments are broken down into 4 segments. Okay. I'm going to code this. This is the media segment. This is the park segment. This is our studio segment. And then this is our consumer product segment. Just like that. So then these ones include ABC. I said NBC earlier, but it's actually ABC, ESPN, etc. These include the theme parks here. And then these are, Marvel and Star Wars and et cetera, et cetera, et cetera. This is also the direct to consumers. That's Disney Plus as well. But this here is what I really want to focus on, Fabio. And basically what we're looking at here is we've got Orlando, we've got California, and we have Paris. These 3 Disney owns, period. Tokyo, let me see if I can write this. Tokyo I believe that is licensed. Like Disney collects a licensing fee,
Yep.
so like a third party owns the Tokyo park. I believe that's the case, but I'll provide further disclosure in the description and the pinned comment of this video. And then out of this comes their Asia markets here. And this includes, Fabio, the VIE structure itself. Okay. This includes Hong Kong and Shanghai. Now, let's say, just for the sake of this example, this is not actually the breakdown of the revenue structure itself, but let's just say for the sake of a simple example, Fabio, we then take this and we have O, C, F, T, H, K, and then S. And we assign all these little ones. 1 divided by 6 is about 16.67%. Is that right about that?
Yeah.
Yeah. Okay.
On there.
So I gotta find my cursor again. Yes. So these will be about 16.67. So that means that if they come up and just seize the VIE structure itself, 33% of potential revenue coming to the park is now gone. Now, Fabio, I would say for a minimum threshold for a discount rate, because we like to typically use 10% and then we add on to that based on things that we can discount. I would say this immediately, Fabio, the margin of safety that I would want here would be 100% to 200%. So let's say that we add another 15% to our discount rate. Would you agree with this, or would you want to see something different, or not even doing this at all? Would you want to completely discount the park because that's a risk that we can't account for, and just focus exclusively on the other business segments Disney has?
I would focus more so on the other business segments. However, I mean, I would assign a discount to those two parks already, because one video that's should be out already is the video talking about capital restrictions in China and what businesses have to go through. So they have to apply for anything greater than a certain amount. And businesses in the United States who do business in China, they, for now, under GAAP accounting rules, they still classify all that cash as just cash. However, one of these is not the same. So the cash generated in China is not the same as the cash generated anywhere else in the world due to these capital restrictions. So because cash is supposed to be the most liquid form on the balance sheet, and it's supposed to be readily available to pay any bills that come up. But that's not necessarily the case for cash generated and held in China. So I wouldn't discount it to zero, because those are things that could change in the future, but I would apply a heavy discount to those operations. I mean, as conservative as you want to be, you can just apply a 0% valuation to those individual parks and then see what comes up. I'm more interested, and I think a lot of people are interested, I don't know if you'd agree with this, with the direct consumer product as it pertains to Disney Plus. Everyone's talking about Disney Plus and the potential that they build a Netflix with inside the larger enterprise that is Disney.
Yeah.
What do you think?
I think that's definitely a reason to be bullish. And like I was kind of telling you, the fact that the VIE and the fact that their Asia parks themselves are structured as a VIE, that doesn't exactly deter me from Disney. But
Yeah.
I would not buy, me personally, I would not buy Disney right now. Because the thing about Disney, the reason why I am frankly the most bullish on it now, Disney Plus is a great thing. That's a great thing to take into account. Disney's working hard at it, kind of going into the future. But the number one reason why I am bullish about Disney is their IP portfolio.
Oh, yeah.
Fabio.
Oh, yeah, I
Because
agree.
that right there, because like Disney is such a weird character because it doesn't exactly fit into one particular industry, and everybody tries to pigeonhole it into one industry. It's real estate, it's media. And so kind of the whole media industry as a whole, and especially with movies, if you can amass a sizable amount of in-demand IPs in your portfolio, that's an incredible moat, Fabio. So the people that are bullish on Disney and saying it's a forever stock, yes, but there are risks with this. And now, Fabio, I kind of want to plug Disney into your model now and kind of see what it returns. We hope you enjoyed our video today. And part 2 will be coming out tomorrow. So please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. We're your hosts, Austin and Fabio, and we look forward to seeing you tomorrow. Take care.